Look at this map. Here is the Strait of Hormuz. It is a narrow, incredibly important waterway in the Middle East. Roughly 20% of the world's oil actually flows through this little choke point. Now draw a line 8,000 miles across the globe, all the way to Houston, Texas. Now, if you want to understand how global economics actually works and how a geopolitical crisis on the other side of the planet actually dictates whether or not you can afford a 3-bedroom house in the burbs, look no further than this video in Houston, Texas. Matter of fact, in late 2026, the United States and Israel launched coordinated strikes on Iran. Almost overnight, the Strait of Hormuz was effectively closed to tanker traffic, and it created a huge fallout. Brent crude oil went up to $118 a barrel, and that is the largest since 1990 Gulf War. But this video isn't about politics or the war or any of that. It's about the economic butterfly effect that happens because of oil. And it not only was the United States affected, however, Houston is ground zero. Houston is an exact replica or example of what can happen when your economy is based on energy. To understand housing, you have to understand the chain reaction. It goes like this. War influences oil, oil influences inflation, and inflation affects bond yields, and bond yields affect mortgage rates. See, going into 2026, the housing market in Houston actually looked great. 30-year fixed rate was under 6%. People were getting ready to buy, and then boom, the conflict started. Oil prices surged. Manufacturing, shipping, and groceries went up immediately. The bond yield market actually went up huge 10-year treasury yield spikes. So now we go from a 5.99 to 6.38% interest rate. That doesn't sound like a lot, but it actually increases you $22,000 in interest on a modest home at $300,000. But here's where the story gets crazy. Houston isn't like everybody else, like I said. Houston is ran by energy. So when oil prices spike and the rest of the United States feels like a tax occurred, in Houston, revenue is actually huge. Money is flowing. But what we see right now is energy companies are consolidating their power in the city. Expand Energy, the largest natural gas producer in the United States, moved its headquarters to Houston, along with Boardwalk Pipeline, who did the same. See, the region is forecasted to add nearly 31,000 new jobs in 2026. These jobs are high-income professionals that are moving here on corporate relocation packages. So, you think the Houston market be on fire, right? Well, no. There's a massive hidden cost to this oil boom. Building a house is an incredible, energy-intensive process. Think about it. Asphalt shingles, PVC piping, plastic insulation, all of these are derived from petrochemicals. See, when oil prices jumped in early 2026, construction material costs actually surged 12.6%. And the diesel fuel went up 38% just in one single month. Who drives a diesel? I do. There's a lag to this. See, suppliers adjust their prices 30 to 60 days after an energy cost moves. So builders get caught mid-project with blown budgets. They can't afford to build cheap homes anymore. So guess what? The mortgage rates go up, the housing market prices go up, and essentially what you have is a state of normalization that's actually frozen. Houston now leads the nation in housing supply, somewhere around 4.7 months of inventory, the highest since 2012. Homes are sitting on the market between 65 to 70 days, and the median home price has actually gone down in Houston at $345,000. The days of a bidding war are over, my friends. Actually, about 30% of active listings in Houston are seeing price cuts. It's pretty interesting. So if you live in Houston right now, what do? Well, here's a couple things you can do. You move to the fringes of Houston. You get the hell out of Houston. You move to places like Brookshire, Waller, Katy, Cypress, Richmond, maybe Fulshear. Buyers are driving further and they're trading long commutes for bigger lots and better and nicer houses and bigger houses. Or you rent. If you want to live in Houston, you may have to rent. The craziest statistic right now in 2026 is that massive 4,700 single-family homes were leased in 1 month. 16% increase over last year. Because people are priced out of buying, they're choosing to rent. And because the inventory has flooded the market, the average price of the single-family home has actually dropped when it comes to rental. So more people are renting, but the prices have gone down. See, the 2026 geopolitical energy shock didn't crash the Houston housing market. There's no systematic overbuilding or toxic lending like we saw in 2008, so waiting for a crash doesn't make any sense. It's just a realignment. It's a tug of war between massive economic engine of the energy sector and the weight of inflation and borrowing costs. So if you're a buyer, the leverage is yours. You can negotiate, you can ask for repairs, you can ask them to pay for closing costs or even pay for your realtor. But guess what? Your cost of living has gone up, including electricity. Now, if you're a seller, just get it through your head that the frenzy is over. You get the price accurately from day one, or your house will sit month after month after month. The global economy is a web. A closed shipping lane in the Middle East means higher prices for PVC pipe in Texas, which means higher mortgage rates, which was why most families are deciding to rent instead of buying in the actual city of Houston. This, my friends, is the reality of 2026. If you want to sell a house, price it where the market is going instead of where it's at. And if you want to buy a house, hire a real estate agent like us that will tell you how to take advantage of all the opportunities you have. Either way, it is important that you hire a great real estate agent like Vantage Real Estate Group to help you navigate the real estate market, whether you're in Houston or the suburbs. Good luck and get you some.